The multifamily sector has been hit really hard by the rises in interest rates and cap rates we've seen since the end of 2022, and these have come at the same time that we've also seen record high new deliveries of apartment product in many markets across the country. But with the most recent research that's coming out today on the multifamily sector, it's looking like the worst finally might be behind us, with some big changes in market dynamics that are making investors a lot more optimistic. So in this video, we'll walk through why now might be one of the best times to get into multifamily real estate, whether you want to invest in this asset class or work in this part of the business, and what's driving all the optimism in this part of the industry. So the first thing that's driving this is expected to have a very positive impact on both multifamily rents and occupancy levels in this sector, and this is the huge drop in new construction activity we're seeing in the market today. According to Yardi Matrix, multifamily starts in the US have dropped substantially over the past 18 months, falling from a peak of 200,000 units in Q3 of 2023 down to less than 50,000 units in Q1 of 2025. And Newmark's most recent multifamily capital markets report also noted that new deliveries of multifamily product totaled just over 116,000 units in the first quarter of this year, which was a 27% decrease from peak deliveries back in Q3 of 2024. And according to Avis & Young research, over 66% of the multifamily inventory that's currently under construction in the US is projected to be delivered at some point this year in 2025, meaning that new deliveries should continue to fall in 2026 and 2027. And what makes these numbers even more encouraging is that even at a time when multifamily deliveries have been coming in at record highs over the last few years, demand for multifamily product during this time has also stayed extremely strong. From Q1 of 2024 to Q1 of 2025, multifamily absorption came in at over 700,000 units according to Newmark research, which was more than 3.5 times the long-term average in this sector. And according to Cushman & Wakefield, net absorption in Q1 of 2025 alone came in at over 100,000 units, which was a 12% increase over Q1 of last year. And a lot of this continued demand for multifamily product is being driven directly by how expensive it is to own a single family home in the US today, which doesn't appear to be getting any cheaper anytime soon. The monthly cost of home ownership in the US jumped to $3,037 in Q1 of this year, which is more than $1,200 per month higher than the cost of renting a multifamily unit. And this spread between these two figures is now more than 2.8 times the long-term average. The trajectory of purchase applications of single-family homes tracked by the Mortgage Bankers Association also tells a very similar story, with these down over 50% from their Q4 2020 levels to some of the lowest figures we've seen in more than 25 years. Now, because of this combination of falling supply growth and continued increases in demand, we're finally starting to see some positive changes to multifamily rent growth and multifamily occupancy levels in many markets across the country. According to Newmark research, the national multifamily vacancy rate dropped to just 5% in Q1 of this year, down from 5.9% in the first quarter of 2024, and this figure is now sitting at 50 basis points below the long-term national average. And on the rent growth side of things, CBRE reported that in Q1, multifamily rents across the US increased by 90 basis points since Q1 of 2024, with major gateway markets like San Francisco, Chicago, New York, and Boston all seeing positive rent growth figures of over 2%. And while this is all very good news for current owners of multifamily product, beyond just the positive impacts on the operations of apartment properties, we're also starting to see some very positive trends in the multifamily capital markets, with upticks in transaction volume that we haven't seen in years. Multifamily loan originations jumped by 32% year over year in Q1 of 2025 as 5-year and 10-year US Treasury yields finally started to ease up, and with almost $800 billion of multifamily loans that are maturing over the next 2.5 years, we'll very likely continue to see a spike in originations as these properties are either refinanced or sold. And on the investment sales side of things, transaction volume in the US jumped by 36% year over year in Q1 of 2025. And according to Newmark, multifamily transactions accounted for over 30% of all commercial real estate sales in the US, which is 280 basis points above the long-term national average. Now, while the growth story of this asset class is really compelling at the national level today, what I'm finding most interesting about this sector right now is where this growth is happening geographically. Over the last 2 years, the strongest performing markets in this part of the industry have historically been some of the least attractive metros for institutional investors to get involved with secondary and tertiary markets like Lexington, Kentucky, Providence, Rhode Island, Hartford, Connecticut, and Omaha, Nebraska, all seeing some of the highest multifamily rent growth throughout the entire country. And what's even more surprising is that in Q1 of 2025, all 23 Northeast and Midwest markets tracked by CBRE posted positive year-over-year rent growth of at least 1.8%, with cities like Detroit, Kansas City, and Milwaukee all posting rent growth figures of over 3% year-over-year. And this is all happening at the same time that the markets that saw the biggest rent growth figures in the 2010s and early 2020s are dealing with a huge influx of new multifamily supply, with cities like Austin, Denver, Phoenix, and Atlanta all seeing rents drop on a year-over-year basis by more than 3%. It's also really interesting to note that from a capital markets perspective, investors also seem to be shying away from many of these historically high growth metros, with cities like Los Angeles, San Francisco, Denver, Phoenix, and Orlando all seeing year-over-year drops in total investment volume. So while we still have to work through a lot of supply pressures throughout the rest of this year, it's looking like with the combination of multifamily construction starts and new deliveries tapering off, continued demand fueled by the cost of homeownership, and the potential for distressed acquisition opportunities as almost $1 trillion of multifamily loans mature in the next 2.5 years, there could be a lot of near-term upside for both investors that want to get exposure to this asset class and also industry professionals that want to work for a company that's focused directly on the multifamily sector. And if you're watching this and you are looking to break into multifamily real estate and you want to make sure you have the technical skills you'll need to analyze investment opportunities or pass an Excel modeling exam that might be given to you during the interview process, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more deep dive content on the multifamily sector or any other commercial real estate asset class, make sure to hit the like button and let me know. And let me know in the comments what you think is next for multifamily real estate. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week. And I'll see you in the next video.